Okay, good afternoon and welcome to Asset Finance Connect's Christmas debate, which focuses, as pretty much everything has for us since that fateful day in October, on the Court of Appeal's judgment that intermediaries have a fiduciary duty. At Asset Finance Connect, we've covered this judgment in some depth, starting with a webcast held just 7 days after the verdict, after the judgment, excuse me, now watched by over 2,000 industry professionals, and that provided an overview of the judgment and the FLA's response. The most significant element in that analysis, in our analysis, was the news that the FLA guidance, which was that all brokers and dealers should disclose and get informed consent, was that was in fact a gold plating of the judgment. The ruling actually adds, where the customer is sophisticated, there's no requirement to disclose. So the fiduciary duty remains, but what that means depends on lots of other variables. So this gold plating has, of course, got big implications for those businesses that only deal with sophisticated customers, something which will no doubt come up quite a bit in our debate today. At our autumn conference held 2 weeks ago, just after a month after the verdict, we worked with the NECFB and the FLA to help brokers to navigate the nuance in the judgment. And we talked about 3 C's. So the first C is complexity, which is the topic I've just been mentioning. The industry should not view, we said, as a group, they shouldn't just conclude, this does apply to me. Actually, what they should be asking themselves is, does this apply to me? And we asked Christian Roelofs, the senior partner at Finitiv, to introduce 4 variables which lenders, brokers, and dealers might consider when deciding how to answer that question. So the first one was the big distinction, which we've all been thinking about, which is between sophisticated versus unsophisticated customers. But that's not the only thing that you should think about in the read across. There's also regulated versus unregulated. There's the difference between the finance advisor being a primary purpose of the intermediary or a secondary purpose. So a secondary purpose example would be where it's a dealer and the primary purpose is to sell the asset, and the secondary purpose is that they want to sell the finance as well. And then the fourth is the nature of the relationship between lender and broker, lender and intermediary. So one example of that would be that there's a difference between a broker who has one lender on their lending panel, or indeed a broker who is part owned by a lender, than a broker who is entirely independent and has a funding panel of 100. And all these things should help you to decide, does this apply to me? So the second C was consistency, and that was another blinder of a point made by Jim Higginbottom, the new CEO at the NACFB. So Jim was handed the judgment to deal with literally days after he was appointed to take his role at the NACFB. And you might have thought that he'd be on the back foot, but he shows no sign of it. So despite devising the 4 variable model that I just told you about, Jim also argued the need for consistency in the industry approach. It's important to be clear what I think he was saying. I hope I'm getting it right. He's not saying this does apply to me. In other words, we should all do exactly the same thing. He's saying what the industry needs is a consistent approach. And this might, for example, allow for variation in treatment that this structure suggests, but within that consistent framework. Which brings me to my third C, which is collaboration. Now, collaboration is a way to achieve that consistency, but collaboration is a double-edged sword, I think we're beginning to see. We can use it, to find the right way forward, and we can do that through the debates and discussions of the sort we're having today. But the danger is if we collaborate too readily and we agree a way forward without letting the different areas of opinion be aired, then we might find the wrong way forward. In other words, we don't just need a consistent approach, we need the right consistent approach. And the right consistent approach is surely to be tested by whether or not it proves to be an enduring remedy for the judgment the court has made. It's not an enduring remedy if if the problem just continues, but it just continues in a different form. So we don't want a knee-jerk response made in shock after an unexpected verdict. And now, 6 weeks after, excuse me, is a time to reflect and to make sure that we have gone the right way. And there I begin to detect there are some worries amongst our community. So James Baird, a partner at Gately Legal, had his doubts about the way forward. And he said, there is a danger that the whole industry is getting tarred with the same brush. So he clearly feels there's too much focus on a single solution. This does apply to me, when actually he's saying for a lot of the industry, it's completely unnecessary to be doing all these things. It just doesn't apply to them. On a separate point, at the BVRLA conference, I expressed my concern that there wasn't enough conversation about the word fiduciary or the words fiduciary duty, and far too much focus on commission disclosure. So today's conversation will really focus on fiduciary duty, and we're not really going to, I don't think, deal that much with the redress stuff. I'm not sure there's much to say just yet. It's not really about the informed consent document process and how well that works and how you deal with the bits and pieces around that, because a lot of those conversations we've already had. And it's not really about whether or not you should disclose commission, because we've had that conversation too. So today's conversation really focuses on fiduciary duty, and that was picked up by a senior member of one of the fleet finance companies who was at the BVRLA conference, who made his personal observations to me. They weren't his company's observations. He said, my understanding of fiduciary duty, hopefully correct, is that it ensures that the customer always gets the best deal, not the best deal for the broker or the lender, and they're required to provide that and to act in their best interests without caveats. He said, we need to move the conversation on from the backslapping of saying that lenders, trade bodies and brokers have come together to collaborate on this issue. So he's saying find the right collaboration, the right solution, not collaborate regardless. He said, I don't see enough people wearing the customer's shoes in this debate. What I would want the purchase experience to be like if my son or daughter was financing the car, or if my vulnerable parent was financing the car. That's what I'm looking to achieve. So his sentiment really reflects my worry, which is that in the shock of the judgment, we've all commendably agreed to collaborate, but in doing so, we've ignored the question, does this apply? And accepted the view this does apply. And we've also started to say some rather extraordinary things in the informed consent documents. And I'm beginning to wonder if we've stopped even really hearing what we're actually saying to our customers. So the one that struck me most was the statement, the broker is not acting in your interests. This remedy to a conflict of interest or a fiduciary duty seems to me to be wrong-headed. If we really believe that the broker, in the current way he or she is presented, is not acting in a reasonable, honest and decent way, and to be clear, I think that in most cases they are acting reasonably, honest and decently, then we need to fix that, not just disclose against it. If we disclose something like that, then we normalize, in my opinion, something quite extraordinary. We make our good actors say they are behaving like our bad actors. And if that is the result of the judgment, then really nothing good at all will come out of it. If instead you believe, like me, there is a reasonable position to argue that it is absurd that you should view a broker or a dealer like a doctor who, as a matter of life or death or freedom and imprisonment, must only recommend the absolute best way forward, and that you don't see the lender as a storekeeper who offers his ways or that you do see them as the storekeeper who offers his wares in a straightforward way to customers who know that some products on the shelf have a bigger profit than others. If that's what we believe, the storekeeper thing, then we need to fight for that rather than to disclose against it. So the AFC view really now is that 6 weeks after, we need to start to take stock and have those conversations. We frame these difficult discussions as formal debates because they're thought experiments. You cannot assume that the participants in the debate believe what they're saying. And indeed, we've asked John and David to swap roles from the similar argument they had about commission disclosure earlier this year. They're just making the best case they can. if you like, we've built in the dissent. We've made it okay to say the unsayable, to not collaborate, with the objective of determining the right collaboration, and not just to rely and desire collaboration, regardless of whether it's the right way forward. So you can hear what the teams say and you can make up your own mind. And the other thing I want to say is we're not official representatives of the industry. So if you're a claims management company listening in today, you can't quote us as speaking with any authority. In this instance, we have none. We're the marketplace for ideas. The final thing I want to say is we make no apologies for Mr. Scrooge-like using a Christmas debate to discuss how to organise our industry better and to make more money and to look after our customers better. That's our role at Asset Finance Connect. In a moment, I will hand you over to Judge Jason, who is Director of Sales for Europe at NETSOL, an ex-industry practitioner from Aldermore, and Aldermore themselves are a business that depends on broker and dealer partners as a channel to market. Judge Jason will take the starter vote and he'll manage the 3 sessions. So the 3 sessions are these. The first session is the Asset Finance Connect team will argue the 2 positions. John Rees, our head of equipment finance at Asset Finance Connect, will argue in favour of the motion. David Beckley will argue against the motion, and they'll both speak for 10 minutes. The second session, it's really up to you, the audience's turn. So we'll ask you to make your points. Please speak up. If you don't, we'll only be here for a fraction of the hour, and that will be your fault. Chatham House rules apply. No comments may be attributed. What goes on in Christmas debate stays in Christmas debate. And anyone caught breaking that rule will find that Christmas is cancelled for them next year. You don't need to identify yourself when you make a point. Change your name on the board if you want to. I will ask people to come up and make their points direct, but if they don't want to, then they don't have to. Just click no, and I'll ask the question for you. And if you worry that you can still be identified, then make a point through me, as I said. I accept my fiduciary duty as your intermediary in this debate. We have, in fact, asked some people to ask questions that are not what they believe to stimulate the debate. So you can have further reassurance that nobody will say, he's asked that question, he clearly believes this, that, or she has said that. And if all that doesn't persuade you to contribute, perhaps Judge Jason, or JJ, as I'm choosing to call him's prize of a bottle of champagne for the best audience-led point will provide the necessary encouragement. So he's going to choose somebody to get a bottle of champagne at the end. You won't get a chance to win the champagne if your point is made anonymously, because we won't know who you are. And finally, since James Baird gave me a hard time when he made his points to me by email, I'm going to ask him to kick off with the first point in the audience part of the session. So the 3 sessions are David and John speak, the audience speaks, and then I'll ask finally the audience to, the David and John to make some summing up statements. We'll take a poll at the beginning, we'll take a poll at the end. The winner will be, the winning speaker will be the one who moves the vote most in their direction. The motion will, of course, just be carried by who has the majority, a simple majority for or against. Jason will choose the best audience interjection, the funniest, the most clever, or the most blatantly self-interested, I'd like as well, please. So that's it from me. Over to you, Jason.
Okay, thank you, Edward. You've covered off the structure of the debate very well, so I think everyone's pretty clear on where we are. But make no mistake, this is a competition. There's a competitive debate between David and John here, and we want it to be. And there will be points awarded, if you like. There will be a poll taken up front, which should be on the screen now. If everyone can place their votes now, we'll run another one later.
Sorry,
as I mentioned. No worries. My job as chair is to keep the debate fair. Hang on, I shouldn't vote. That would be inappropriate. It just popped up on my screen also. My job is to make the debate fair and make sure there's enough time granted to everyone who can talk. As Edward mentioned, in order to win this bottle of champagne next to me, you will need to sort of come on and make your case and ask your question, and we'll make it possible for you to do that and come and say that. So it should be a lot of fun. Let's see what comes out of the debate. There'll be another poll at the end, and it should be a very interesting opportunity to have this discussion in a format where people can speak without fear or favour, and we can just talk about the issues. So, without further ado, I will turn over to John, who's going to make what's called the proposition. And just to remind again that the motion posed is this. This House believes that nothing good will come out of the decision to make intermediaries into fiduciaries. John, over to you.
Thank you, Jason. Can I immediately, Judge Jason, ask you to deal with the outrageous intimidation that David has already started by wearing a Christmas shirt emblazoned with Manchester City? He clearly knows that I'm a Southend United fan, and when I went there yesterday to buy their Christmas jumper, they don't do one. And I find that completely out of order that he's decided to wear a Manchester City Christmas jumper.
We'll call that a yellow card, David, shall we?
If you like.
Perfect. Thank you very much, Judge Jason. Let's hope all your decisions go in that direction. Yes, let's just remind everybody again, to labour the point, what Jason just said. This debate is about the appeal court decision that makes intermediaries fiduciaries. Please don't confuse the motion with any other issues. It's a fairly binary point. This discussion, this debate is not about commission disclosure and whether that's right or wrong. It's about the intermediary being given the role of a fiduciary in their relationship to the customer, be they a consumer, a corporate, or anything else in between. And the decision comes with an imprecise concept of sophistication, which brings all sorts of challenges for the industry to deal with, because it's so imprecise as to what that definition of sophistication is. So please, when you listen to us, can you keep in your mind that this is about the decision of making intermediaries fiduciaries? So let's consider a couple of the analogies that Edward used in his introduction. This concept of making a comparison between doctors and lawyers who willingly accept their fiduciary duties, and comparing those to finance intermediaries. Is it really correct for a customer to believe that a finance intermediary is acting in a trusted advisory manner, such as a doctor or lawyer, with no financial interest, when helping a customer decide which finance offer to take for an asset or car? Is the customer's expectation that a finance intermediary is acting in the same way as a lawyer or a doctor? I don't think so. As many have said, and as Edward said in his introduction, does a shopkeeper have a fiduciary duty to advise their customers which product to buy? The intermediary has a professional and strong commercial relationships with its customers. Now, possibly there could have been more transparency in the past about the financial rewards they benefited from, but let's not anyone try to convince us that they have a fiduciary duty to their customers, least of all the appeal court. The customer remains supreme in the relationship and can stop or change the deal as it wishes during the sales process. Let's consider for a while this concept of sophistication that the appeal court introduced as well. Ask yourself the question, does a lawyer or a doctor have a different responsibility depending on who they are advising? Trying to unpick this sophistication topic inevitably ends in an uncertainty. And as we all know, the finance industry, all industries crave certainty. They crave to understand the playing field that they're operating in. If you don't have certainty, it just results in a complexity of processes, a change in the risk profile, and then additional costs. Lenders, in trying to decide which bucket of sophistication potential clients fit into, will inevitably duplicate or complexify their processes, which ultimately ends up in additional costs as they try to cover the costs of those additional processes. Do they end up, the customer, in getting a better deal as a result of this uncertainty and complexity, which results in additional costs? Even more extreme, perhaps, does this uncertainty stop lenders playing in this market, which means that there's less competition in the market, which results in interesting costs? There is already in our industry enough pressure on lenders to provide a sufficient return on equity to their shareholders without the additional burden of trying to unpick this sophistication point. Let's consider this another way. If we accept this ruling, will intermediaries want to continue in this trade? It's a huge responsibility to be a fiduciary. They are connectors in markets, helping facilitate transactions for commercial reward in an incredibly professional and knowledgeable way. But imposing a fiduciary duty fundamentally changes their role. Do intermediaries want to become trusted advisors? Perhaps the advice they would have to be would use your own cash and don't finance. Or do you want to remain the arrangers of commercial transactions? Again, please remember the motion. It is about the creation of the fiduciary duty. Our great, resourceful and resilient industry has reacted brilliantly to this appeal court ruling, finding ways of continuing to provide billions of pounds of facilities to consumers, SMEs and corporates. But if you build your business models on a false principle, it never ends well. The foundations must be strong and correct, or the building will eventually fall. This debate is not about commission disclosure, which the industry has found practical ways to manage. It is about fiduciary duty. If we do go in the direction of the trusted advisor, perhaps we end up with the customer paying a fee to the intermediary and the lender not remunerating the intermediary at all. That is how lawyers would be remunerated, paying fees for their advice. I urge you to challenge the principle that the appeal court has taken. Fight the principle of fiduciary duty, or else we build an industry based on a false concept. Maybe we can be more transparent in our fee structures, but don't allow a false principle to be a foundation of our structures and processes. The courts and regulators may delight in seeing our economy drift further and further away from a free market economy towards a nanny state. But as an industry that hangs together to defend our industry away from this false concept that intermediaries are fiduciaries with a role of providing the best possible deal for a customer, it is a commercial relationship. So let's find a start point to the issue and find the right consistent approach. Challenge via the Supreme Court the ruling over fiduciary duty. Thank you.
Thank you, John. Very good. Fraction over time, though, but very well said. So to summarise there, uncertainty, your submission would be uncertainty, less competition, more cost for the industry. Will it reduce choice or have less brokers out there that can support? And ultimately, your message is fight the power. Okay, David.
It's a mighty city.
Okay. David, over to you.
Okay, Jason, thank you. So first comment to John was, Christmas, John, is all about celebration. And the reason why Manchester United don't have any jumpers is because they've got nothing to celebrate. They've not won anything for such a long time. So I think that answers your question. If there's a vote for that, then hopefully that wins. Anyway, So I'm going to argue. That the motion from the Court of Appeal on the 25th of October to make intermediaries into fiduciaries will not have negative consequences. However, but I think the ruling will strengthen. I think the ruling will strengthen the operational practices in the industry in the short, medium, and long term, strengthening accountability, transparency, and fairness in all transactional situations. And in turn, it will deliver benefits for customers, lenders, intermediaries, and indeed the broader economy. And I'll come on to all these points later. The first and very important point to make is that this is a court ruling and it contradicts the FCE regulations that the industry was adhering to, in almost all cases, adhering to them but to the letter. I think the industry is therefore right to feel somewhat aggrieved by the ruling. And of course, the CMCs were left rubbing their hands with glee. And that's my first attempted Christmas joke there, where I'm rubbing their hands with glee. So hopefully people are laughing about that. Anyway, and Edwards also called this decision the gift that gives on giving. And that's my second Christmas joke. And I'll show you in the next 10 minutes that the decision is actually a gift for the industry and not a burden, as John has tried to paint it. So let me present a bit of background to this rather unexpected decision. At the AFC conference in November, Wayne Gibbard, who's a partner at Shoesmiths, he advised that the legal and regulatory landscape is complicated in the UK by the fact that there are competing regulatory authorities. We've got the common law, and this is the basis for the fully secret commission being considered bribery. The 1974 Consumer Credit Act, this predates mobile phones and is no longer fit for purpose 50 years later. The Financial Conduct Authority, and that's been in business since 2014, took over from the Office of Fair Trading. The Financial Ombudsman Service, which has been with us since 2007. And then we've also got the independent judiciary, which is the county courts, the Court of Appeal, and indeed the Supreme Court. So the decision by the Supreme Court on the 25th of October, however unfair, is a result of this complicated legal landscape in the UK, but it is an opportunity to tidy up the regulatory landscape in the UK financial services industry. And this is something very good that has come out of the Court of Appeal ruling. So you're going to hear a lot more about tidying up. I'll go on to that now. But tidying up doesn't simply mean more regulation. Over-regulation can be too complex and can be as bad as under-regulation. And over-regulation stifles innovation, and over-regulation is a barrier to growth. And this has been recognised indeed by the incoming government. And Edward mentioned in his opening remarks that the industry needs the right, consistent approach. So tidying up opportunity is the chance that the industry has to introduce better regulations in financial services that strike a balance between protecting customers, ensuring financial stability, and fostering innovation and competition. And before I explain how better regulation is crucial for the industry, let me just remind you, everybody, of the impact that bad regulation can have. One excellent example of bad or ineffective regulation was the PPI scandal. The regulations at the time allowed the sale of PPI alongside financial products like loans or mortgages. Poor oversight and loopholes in the regulation led to widespread mis-selling, with customers being sold unnecessary or unsuitable policies. And the fallout resulted in billions in compensation payouts, damaging the industry's reputation. And moreover, there was not an understanding in the industry that dealers and other intermediaries had a fiduciary duty, and this was the main contributing factor to this particular scandal. Having a fiduciary duty would have stopped this scandal and the £30 billion compensation payout. And even if I had nothing more to say, then this is surely sufficient reason to reject the motion. So I hope we're all agreed that we need to avoid any more PPI issues, and I'll argue now that the way to do that is to take this opportunity to tidy up the regulatory landscape. The tidying up also requires intermediaries to have a fiduciary duty, and we frankly have to accept that this is now the law, certainly where an unsophisticated customer is concerned, and embrace the opportunity. You'll hear a lot about fiduciary duty in this submission, so please keep that front of mind. Fiduciary duty means acting in the best interests of someone else, such as a shareholder, partner, or a client. So at this time of year, think about Santa. He has a fiduciary duty to everyone all over the world at this time of year. He's busy with his elves at the North Pole, making sure that everyone who has been good gets what they want for Christmas. So please remember that. And John argued that intermediaries, like motor dealers, should be simple shopkeepers and not doctors. Well, that might be the case if financial intermediaries were selling a loaf of bread or a tub of margarine, but they are not. They're selling complicated financial products. And in the case of a motor dealer, are selling the second largest single purchase after somebody's house. When you buy a house with a mortgage, then the mortgage broker has a fiduciary duty. So why shouldn't a motor dealer, a salesperson, have that same responsibility? So let's look at fiduciary duty in a bit more detail, and let me explain why it will improve the industry environment for customers, intermediaries, and lenders, and be a lot worse for the claims management companies. More Christmas cheer there. So firstly, fiduciary duty requires intermediaries to act in the best interests of their clients. Consumers often rely on intermediaries for guidance in complex markets like financial services, and by holding intermediaries to fiduciary standards, the decision ensures that their advice and actions prioritize client welfare over self-interest. And fiduciary duties deter predatory practices like PPI, creating a fairer and more ethical marketplace. Well, wouldn't everybody on this call want that for their parents and their children? The second point is strengthening accountability and trust. Fiduciary duties impose clear responsibilities, reducing conflicts of interest, and this encourages intermediaries to act with integrity, improving market reputation and client confidence. And trust is a critical component of efficient markets. Intermediaries held to fiduciary standards are more likely to attract clients and facilitate smoother transactions. Thirdly, long-term benefits. Consumers are more likely to return to intermediaries they trust, strengthening market stability and profitability for ethical actors. And fiduciary obligations promote professionalism and quality, raising standards across entire industries. Fourthly, mitigation of risks. A really important point is the avoidance of conflict of interest. Being incentivized to prioritize our own products over client interests leads to a conflict of interest. Fiduciary duties counteract these tendencies, contributing to greater market stability. And by holding intermediaries to higher standards, the decision can help prevent scandals such as PPI that I mentioned earlier, that damage public trust and undermine entire industries, and also fuel people like Martin Lewis. And fifthly, encourage market innovation. Competition differentiation occurs where intermediaries who embrace fiduciary responsibilities can differentiate themselves by offering higher quality client-focused services. And fiduciary duties push intermediaries to innovate in ways that genuinely benefit clients rather than exploiting them, fostering a more ethical and sustainable form of innovation. And sixth, the modern business environment increasingly values accountability, transparency, and social responsibility. Consumers and stakeholders are demanding higher ethical standards from businesses, imposing fiduciary duties on intermediaries. And finally, let's not forget the economic benefits of better regulation. While fiduciary duties might initially increase compliance costs, they also reduce the likelihood of disputes and lawsuits stemming from unethical behaviour. And a reputation for ethical practices and consumer protection can attract both domestic and international investors, boosting economic growth. Indeed, only last week, Charlie Nunn, the CEO of Lloyds Bank, wrote an article in the Telegraph warning that the car finance crisis is bleeding across the UK economy. His warning went on to state that regulation needs to have all the 7 elements that I've just outlined above. Otherwise, the UK will become an unattractive place for both inward and external investment. This warning has serious ramifications that stretch well beyond the initial impacts of Commission disclosure and informed consent documents. And indeed, when Charlie Nunn warned about bleeding, he was referring to the extension of the impact of poor regulation into the secondary lending or wholesale market that provides the liquidity to the customer-facing lenders. All lenders are supported by secondary or wholesale funders, typically by issuing bonds and ABS. Bad regulation has the potential to impact the credit rating of lenders and see the reduction in the share price of Close and Lloyds, for just 2 examples, which in turn makes their portfolio, which supports their wholesale lending, less attractive, resulting in fewer liquidity options and increased pricing, which in turn is passed on to the customer. All lenders rely on the use of ABS funding to supply liquidity, and the providers of this type of liquidity have concerns about the effectiveness of regulation and, importantly, the sword of Damocles in the form of compensation claims as a result of poor regulation. And if that's the case, they lose appetite, and because of the increased perceived risk, they just simply increase pricing. And of course, the knock-on effects at the point of sale are easy to identify. Lenders increasing the bar for acceptance, impacting disproportionately lower credit rating, read more vulnerable members of society, and increasing the price of credit for everyone, whether prime or subprime. So in conclusion, a great deal of good will come out of the Court of Appeal decision as a catalyst for tidying up what is a messy regulatory landscape. The appeal court's decision to make intermediaries into fiduciaries is a progressive step that prioritises fairness, accountability and trust. And while there may be transitional challenges, the long-term benefits far outweigh the risks. The different players in the industry will have the opportunity to ask the question, does this apply to me versus this does apply to me? Different sectors that service sophisticated customers will have a different agenda to those that service unsophisticated consumers. But now is the time for every actor in the industry to take a breath and use the uncertainty unleashed by the Court of Appeal ruling to make the changes that will ensure they are fit for the future. For all these reasons, this House should reject the motion, as the Court of Appeal judgment delivers certainty, which John argued was the most important issue to be tackled. The decision has the potential to deliver certainty and bring significant positive change. Thank you.
Thanks, David. Very good. Slightly over time, but we'll go with it. It started a bit wobbly when, I always find if you to explain to people after the fact that that was a joke and then explain it again, then that's not always the best way to start a debate. However, it did get stronger. You talked about fairness for all, strengthening accountability and trust, and that trust is critical for effective and efficient markets. All these things are true. You also said this isn't necessarily about more regulation. It's about tidying up and improving the regulation that exists there. And if we had, perhaps we would have avoided some of the pitfalls we're in now and potentially avoided PPI back when. So in summary, you're saying the long-term benefits outweigh the risks. So thanks, David. Appreciate that. Before we go off there are a couple of questions that have come in. Just wanted to let everyone know the result of the first poll. The first poll was 46% agree and 54% disagree that nothing good will come out of making intermediaries into fiduciaries. And we'll test that again at the end. Please be ready for the poll that will come towards the end of the session, and we'll see who's swayed opinion the most. First question up here is James from Gately. I believe you're coming online now to ask us a question. So James, if I can invite you to pose your...
He's done it. Great.
James, are you there?
Yes, hopefully you can hear me.
We can hear you but not see you, but that's entirely up to you.
I don't know why that is. Hang on.
We can hear you, but there you are. Hello,
there we are. Now you can see me. Well, that's been a very stimulating debate. Thank you very much, gentlemen, and Chair and Judge. Here's a question. Does the panel understand in law what a fiduciary is? Would you like me to assist?
We're giving David is defending it. Let's pass that to David.
Well, I think I tried it in my debate to explain what a fiduciary is, and they are the idea, or my understanding of a fiduciary is that they are to act in the best interests of the client and not to be self-interested, and that's why I think we should reject the motion, because we should have a fiduciary that it provides sound advice to consumers, rather than simply trying to find a solution to sell to the consumer that earns them the most commission. Sorry.
And can I just speak to that and say, what a brilliant question. Thank you very much, James, because I think that very few people on this panel and in the audience probably really do understand the absolute role of a fiduciary. And for that very reason, it's a nonsense that intermediaries are being asked to be fiduciaries, because they don't want to be them and they don't understand what that responsibility is.
Is there something missing in the definition, James, that you would draw attention to?
I've turned my camera off, but I'm still here. Hopefully you can still hear me. I'm a solicitor, for those who don't know. If I'm under fiduciary duties, it's not something that I would recommend everybody taking on with open arms. We spend 6-7 years training to be a solicitor. Doctors spend longer being doctors. They owe fiduciary duties. How's the industry going to train people to be a fiduciary and all of the legal obligations that entails? What's the panel say about the training requirements that nobody's mentioned?
I'd take that one, James. So, I mean, if if you speak to a financial advisor, or indeed you speak to a mortgage broker, then they have a fiduciary duty, and they have to undergo a significant amount of training in order to be able to do that. And as I've argued, that I think that when somebody's buying, particularly when they're buying a car, then this is the second largest purchase that they make after the house. Surely it's the right thing that they get the correct financial advice from the intermediary, and that has to be that the intermediary has a fiduciary duty. And I agree, it puts more responsibility onto the motor dealer, but that's an opportunity to improve training and improve the level of service to the customer, which will in turn mean probably more sales. It'll mean more returning sales, and it will certainly avoid anything like the PPI scandal, which I think cost the industry something like £30 billion, and that's something that we very much need to do to avoid those kinds of things happening again.
Right. Thank you. Appreciate that, James. We have a couple of other people here to make some questions. Also, Conky, I don't know if that's your first name. I assume not. Can you hear us? Speak, introduce yourself, and please ask your question.
Hi, Jason. It's Robert Conky. We know each other.
Hello, Robert. Long time no speak.
How are you doing? Yeah. So my major concern with this is effectively, we've got a retrospective allocation of fiduciary duty. So, a 20-year-old broker, 5 years ago, it's now allocating him responsibility for that. And that's where where this concerns me. So the problem lies if you go from now and you say you've got a fiduciary duty, people going forward know what they're allocated to, what their responsibilities are. But if you're retrospectively going to do that, where does that stop from a sales process? I actually believe if this goes in this point, the problem we've got is going to make PPI look like a dripping tap. And the gush that's going to come, and the destructive means that's going to happen from a retrospective point of view, how we're going to manage the damage to the funders, to the potential lack of existence of the intermediaries as well. And seemingly right at this moment in time, it appears that this is not just allocated towards a retail or a non-regulated business. It's also to a regulated business, but also to a non-regulated business as well. And that's where I completely come along with John's point in relation to that, because if we're not careful, we're going to be allocating the same responsibility to somebody who's buying the first car and they earn £6,000 a year down to CEO of a £500 million turnover company, and that's where I see the dangers, and that's why I think whilst we do need more, we clearly need to take more responsibility going forward, but it really concerns me in relation to the past allocation. So I'm very interested to hear your comments on that.
John, you want to pick that up?
Well, Robert, thank you very much indeed. Thank you for stating so many things that are so clear and so straightforward. Yes, I think I would define what you were saying about where does this go if it goes backwards. I'd also say going forward, you get legal creep all the time. If we as an industry don't fight this concept of we don't think intermediaries are fiduciaries, where does it stop? And then all sorts of people that have no interest in being fiduciaries, certainly have no training, as our previous speaker said, it has to stop somewhere. And at the end of the day, I think customers have to take a certain amount of responsibility themselves for the decisions they make. That's why, it's emotive to use the concept of nanny state, but at the end of the day, people have to be able to make their own decisions, and they can't expect the state to take those decisions for them. Of course, there has to be fair and reasonableness, and people, maybe some people are more vulnerable than others, but I think this just goes too far, and the legal creep danger really worries me in this.
Yeah,
I want to add.
I can make a point there. So this debate really wasn't about the back book, and I agree with you. It says Conchi. I don't know what you first.
Robert. Robert.
Robert. I agree with you. You know, the back book is a very, very difficult issue for everybody, and that's exactly what the point I was making with PPI. We want to avoid any of those things going forward. But I think the FCA have recognised this, and that's why they've introduced a pause in claims being made from everybody. And the likelihood is that there may be some kind of like universal compensation scheme, because if these rules going forward were applied to the back book without any changes, then I think it could be very, very disastrous for the overall industry. So I think and if you look back to what Rachel Reeves talked about in her Mansion House speech just a few weeks ago, she's asked the FCA, the FOS, and the courts to work together to make sure that any kind of impact on the back book doesn't have too serious consequences on the industry. So I think we're concentrating really about the future. The back book is I think I agree with you, is something for a separate debate. But this debate was all about looking forward and whether having a fiduciary duty will avoid problems in the future, not whether it will solve the problems of the past.
Thanks, David, and good question there, Rob, and good to see you. Next up, we have Tony, I believe. Tony, are you there? Can you come on camera? And Daniel will come to you after.
Hi, guys. How you doing? Oh, can you hear me?
Hello, Tony. We can hear you, but we can't see you. But there we are.
That's fine.
Go for it. Tony, if you could give us a question, that'd be great.
Yeah. So good afternoon, guys. So I mean, just picking up on David's point around that we're thinking forward, and on the point of a fiduciary duty. So any of us who have owned a business, we all have a fiduciary duty to our shareholders. That's something that we take on straight away, and we're expected to act in the best interest of the shareholders, and we can be taken to court if we don't. So I think it's not hard for all of us to understand that in certain roles you do have a fiduciary duty. My point, as I've made to David, Edward, and obviously yourself, Jason, is that the new, and I know you're going to be bored of me saying this, and I can already see you smiling, but the solution to this is already here. An AI co-pilot can be trained in all language. I mean, I'm just writing the specification now to the first version that we're looking to build, and I can see Jason laughing because I bet his ear about it.
I hope there's going to be a question in here, Tony. That's the thing.
So I'm just simply saying,
www. What was it? Sorry, I didn't quite catch it.
Yeah. Well, you all know. No. My point is that if it's about thinking forward, the AI co-pilot will ensure, once it's trained, that the customer sees the right amount of offers that are available to it, and the AI co-pilot will be able to speak to the customer in conversation in any language to identify which one of those policies might be best for them and why. So the actual solution to this, if we're looking forward, based upon the testing that I've been done, it is very clear. And so I would say that.
What's the question there, Tony?
Well, shouldn't we adopt an AI co-pilot?
So would that help? Would that help? So the question is, would an AI co-pilot help provide fiduciary duty?
Because I spoke to the lawyers at the end of the conference last week, and they confirmed, yes, that if you had an AI co-pilot that acted in a certain way and recorded the conversation and recorded the authority of the customer, that would solve the problem. Sorry, guys, to go on and on about
that. Was a question and an answer.
Yeah.
But that's all right. That's all right. It's a good question. Can something like that be helpful in helping intermediaries provide or meet the standard of fiduciary duty?
Yeah, I think the point there, Jason, is if you've got a digital interaction with a customer, what you do get is you do get a digital audit trail. So you know that you've delivered the right questions at the right time in the conversation to the customer. You've recorded their responses, whether they've hesitated, and so on and so forth. So I think the way I see financial services going forward is I see more and more of it going online, because you do have that digital interaction that you can rely on if there is a complaint made by the customer that a fiduciary duty was not delivered to the customer. So I think Tony's got, whilst I don't agree with him on all things, I think on that point, yeah, I do agree with him. So.
Okay, thank you. Thanks, Tony. Daniel. And then Julian next.
Hi. I'll keep it brief. So
Thank you.
when I read the judgment, the justices were very careful not to get hung up on what this duty is called. Is it a fiduciary duty? Is it a duty to act in the, with considered best interests? And I would just like to say, what does the panel think about the industry getting too hung up on the language rather than focusing on the practical reality of an intermediary having to act in the interests of both the principal, the funder, and also the customer?
John, can I invite you to come back on?
No, Daniel, I think it's a really good point, but I come back to my point about certainty, and the appeal court didn't give a lot of certainty, and maybe it's a good thing to let the industry make its own decisions. I just always believe that lack of certainty will ultimately always result in increased price, because you think there's more risk, there's a legal risk in a transaction as well as a credit risk and an asset risk, and therefore you increase your pricing. And if you take that to an extreme, you don't play in the market because of that uncertainty. So I think we're actually in the worst place at the moment, because we don't feel we've got a free market, because we've got an appeal court ruling that sort of refers to fiduciary duty. But you're right, it's not absolutely clear and explicit. As you said, they were deliberately a little bit vague, perhaps, in that. So I think we're in the worst of both camps, and that to me brings uncertainty, which all industries hate uncertainty.
So hi Daniel, I'd like to thank Daniel for supporting my point there, really, because I think what I argued was that fiduciary duty would deliver those practical realities, and that's all about trust, fairness, clarity, transparency, and all that sort of thing. That there's a much better customer journey, and will lead to probably significant amounts of repurchase by those customers if the dealer or the intermediary gets it right, and they deliver the legal requirements in a practical and clear and transparent way. So thank you very much indeed, Daniel. Very, very kind of you.
Is that called a consumptive close?
The audience will make up their own mind. Thank you, Daniel. Appreciate it. Julian, over to you if you can come off camera.
Yeah, hi, good afternoon. Two quick questions, and actually I think they build on what Daniel just said. Is number one, would you agree that brokers actually already have fiduciary duty? Because under FCA rules, they have to pay due regard to the interests of their customers. They have to deliver good customer outcomes. So I'm not really sure I understand what's changed. And my second question, which follows on from that, is, aren't professional brokers already doing this fine? And the problem isn't with asset finance brokers, professional brokers, it's with secondary credit brokers such as car dealers, who have that inherent conflict because they want to sell the cars. So they're not putting the customer's interests on finance first.
David?
Yeah, I can tell that one. So I agree. So there is a differentiation. The court made the differentiation between a sophisticated and an unsophisticated lender, Julian. So I think that's already in. But the problem is, as John mentioned, and we've all discussed, is that the definition of a sophisticated customer has not been clearly defined yet. But I think as far as car dealers go, I agree with you. There is an inherent conflict there, and that's why I've argued that they should have a fiduciary duty. So that's, in many ways, that's been covered by the fact that they now have to have complete commission disclosure, and they also have to get the customer to sign an informed consent form. And I think there are ways of dealing with that, and I think digital is one way. And the other way that's now developing in the industry is to have a platform where you provide the customer with different options, and the customer makes the choice of which option they want to make, rather than the dealer telling them that this is the best option that they can make. So there are solutions, technical solutions, that will help car dealers deliver a fully fiduciary duty to customers by enabling the customer to make their own decision, rather than what's happened in the past is that the dealer has made the decision for the customer.
John? Let's come back.
Julian, I think there's a huge amount of sense in what you were saying there, and it goes back a little bit to that conversation we were having. And excuse me, I forget the name of the lawyer we had on at the very beginning.
James
Who asked if we knew what a fiduciary duty was. I'd go even one step further. When we get to secondary intermediaries, such as car dealers, I don't even think they know they are fiduciaries, so let alone how they ought to behave in a certain way. I suspect that they have no knowledge at all that they are fiduciary. And as someone referred to education, do we have to go and tell all the car dealers that are involved in a financing transaction that they need training or something like that? To me, it just creates a very chaotic playing field for everyone to try and work in, and that's chaos isn't a great place to try and do business.
But the thing is, John, the genie's out of the bottle now. So motor dealers are having to perform as a fiduciary duty. They're having to be completely transparent, and I don't think, regardless of what the Supreme Court decides, whether they amend the judgment in some way, shape, or form, I think the genie's out of the bottle, and that's the way that certainly retail financial services business will be performed in the future. It's never going to go back to the way it was before, and I think that's great. That's great news, and that's great news for customers, and that's why this judgment has given the industry the opportunity of tidying up, and that's why, in my opinion, we should reject the motion.
Julian, do you have another point you wanted to make? No. Okay. Shall I chuck you out then?
Listen, please, if I can invite you to ask your question.
Hi, thanks very much, everybody. I'm really new to this, so I apologise if I'm going to make a point or ask something that's completely ridiculous. I've come into the finance industry late in my kind of professional life. I come from a background in health. And to me, it seems that relying on imposing the fiduciary duty to intermediates may give people a very false sense of security in the market. Coming from a kind of healthcare background, I think healthcare professionals really struggle with holding that position of making decisions in the best interests of patients. And having worked with a lot of lawyers in that field, I think they do too. It's a really complicated task to ask people to undertake. I'll get to the question, I guess. I think the other thing is that transparency possibly doesn't necessarily link clearly to exercising one's fiduciary duty, because there's always that question again about sophistication and whether people to whom you are being transparent are able to judge whether you've exercised your fiduciary duty properly. So I guess my question is, what are your view of those things, and is it going to be possible to get to a clearly articulated definition of what a sophisticated customer is? Because inevitably that's going to involve judgment.
Alison, if I may just ask a qualification question around that, might help. The lights just went off. 1 second. Okay. If you come from the medical background, you have if you have a view, and if you don't worry. Okay. In that scenario where a medical professional needs to provide some medical advice to someone who may or may not demonstrate that they are understanding what they're being told, how does the medical profession deal with that?
Okay, so that's really difficult to come from a background in mental health services, and we would often end up in a position where you are asking a panel of professional experts to look at someone's capacity to make a decision in relation to that particular decision, and those kind of processes can be very long-winded and very difficult to achieve a conclusion. I guess where it's something fairly simple, you would look to present information in different ways and in different formats. But again, that depends on you having a very kind of clear understanding of that person's educational background, their particular deficits in terms of information processing. So you're asking then someone in that kind of intermediary role to carry out a very complicated assessment based on not very much information. I think
I'm guessing from a medical perspective, I suppose you're in a position to ask those potentially intrusive questions in another forum, if another forum might be inappropriate. I want to put your question to David, if I may. So, David, I don't know if you can circle back to that question about will it create a false trust, I think is the ultimate. False sense of security.
Can you keep it relatively brief, David, because we're beginning
the answer is John talked about the doctor and shopkeeper argument. I think for a doctor, there's a lot happening under the skin. There's a lot of emotion, a lot happening in the brain that you can't actually see. I think with financial services, it is a rational decision. It's black and white. It's on paper. The numbers are on paper. Everything's there for the customer to see. So I think that's a different fiduciary duty to the one that a doctor has, and that would be my argument. It's certainly not a doctor argument because everything is in black and white. It's in plain sight, and it's very, very unlike what you present to a doctor, where the doctor has to read between the lines.
John, any?
No, I just wish to thank Alison for her contribution and bringing the experience of a different industry. And if understanding your input and your experience of the dilemmas that doctors face exercising their fiduciary duties just makes me more and more convinced that finance intermediaries are nowhere close to being fiduciaries in this. And that's why I advocate going back to the Supreme Court and fighting that decision of the appeal court. Thank you, Alison.
Thanks, John. I think we're all out of time now, everyone, but thank you very much for everyone's questions. Everybody's going to put the poll back up on screen for us all. Has that already happened?
No, I haven't done it yet. Are you happy to do that without making your final remarks? Because
well, I think, indeed, but I guess we can do it in the interest of time, then we can do it side by side, but go for it.
Hang on, John.
A 30-second sum up from me.
Okay, 30 seconds.
Yeah, please do.
It really concerns me that we're even contemplating that financial intermediaries have a fiduciary duty. It scares me of the responsibilities that is putting on people. It scares me about the legal creep that we could be allowing to happen. And to my final point, David, to put some humour into a very serious topic, are you telling me that the Manchester City football players have a fiduciary duty to the 60,000 people that go and watch them every week to win every match?
Not answering. David.
That's an excellent question, John. But I think the answer to that is that's more a question you should put to the manager rather than the players. So the manager, Mr. Guardiola, has a fiduciary duty to the club, to the shareholders, and to the supporters to actually to deliver a win in every circumstance. So I think it's not a question for the players. I think it's a question for the manager.
Do you want to sum up, David, at all?
So yeah, so from my perspective, I think I argued, very strongly that that the fiduciary duty that an intermediary has, whether that's a secondary intermediary or a primary intermediary, is very different to a doctor. The financial intermediary has the ability to present everything to the customer in black and white. That's from the monthly payments to the amount of commission, and that clearly has not been done properly in the past. So that's why having a fiduciary duty with clear rules and transparency and regulation is incredibly important. Very different questions for the back book, and that's subject to a separate debate. But going forward, there can be no argument that having a fiduciary duty and delivering that information to the customer clearly in black and white, that there can really not be any other alternative.
Thank you, David. Now, what we traditionally do at this point is we take the results of the poll, but I think that the results are still coming in, Edward.
No, they're in. They've moved even further in that direction. I think
so. We started out then. This is where we see if John or David wins on this very important Christmas debate, and there's a bottle of champagne in it for the winner. Started out by 46% agreeing and 54% disagreeing that no good will come from making intermediaries into fiduciaries. So, Edward.
So
you can be Santa and give out the results. Yeah.
Yes. So the final people, they usually pause I'm a celebrity, get me out of here. And then David needs to be tumbled into a vat of something. 65% agree with the motion. This House believes that nothing good will come out of the decision to make intermediaries into fiduciaries. So the House motion is carried. The swing is 19%, I think, if my maths is right, in John's direction. So the amazing outcome of that is that it's 1-1 in our debates. John has won this one. David won the preceding one. John wins the bottle of champagne. So back to you, Jason. What about the most interesting, funny, or self-serving comment? I don't think we should do self-serving because
perhaps no. There were some excellent questions from across the group, ranging from for and against, from Julian, from Tony, from Daniel, from Rob Conkey. But I must admit, I think my favourite by far is Alison bringing in a perspective from another industry, and I'm posing the question of, even with making brokers fiduciary duty, will that give people and the market a false sense of security on the advice that they're given? And I think that's a really interesting point. Even with it, will it make a difference?
Yeah, I think
Alison, congratulations. If you could, we need to get your details, and we'll send you this bottle of Verve I have in my hand here.
I'll send it to you. I know we've been emailing separately, Alison, and the great contribution from Tony as well. I was being facetious, so wouldn't want him to feel I wasn't. Thank you all very much indeed for your time today. Thank you to David and John for their arguments. Thank you to Jason, or JJ, as I tried to get you called, but nobody did it. For your presiding, great presiding. Thank you to all the people who put their head above the parapet and spoke up and asked their questions and so on. Have a really great Christmas. We look forward to picking up this topic in the new year. Hopefully we'll get a little bit more clarity, perhaps when the Barclays judicial review is through. There's also stuff happening with the FCA and Consumer Duty that's rather overtaken us, and we'll be focusing on that too. Have a great Christmas. See you in the new year, and thank you for being members of the Asset Finance Connect.
Well done, John.
Thank you very much indeed.
Bye-bye.
Manchester City 0.
Bye.